Hi, everyone, and welcome to this session of the massively online open course in digital currencies for the master's degree at the University of Nicosia. This is Andreas Antonopoulos, and I'll be answering your questions from the last week's session, covering all of the questions you asked in the forum over the week, and also answering your live questions. You can submit your live You can leave your questions online as a comment on the YouTube, or you can also leave your questions on the Google Plus page that accompanies this Hangout. And with that, let's get started. Themba asks, can you please elaborate on how we can find the details of a transaction from the transaction ID? Inputs, outputs, Bitcoin spent, fees, blocks, etc. Well, this information is essentially stored on the blockchain. And in order to retrieve this information, you can either use the Bitcoin Core reference client, which you download and install on your own computer and build your own copy of the blockchain. And that way, you have an authoritative record of the information of a transaction. Once a transaction has been confirmed, its transaction ID is final. And then you can look up all of the information you just mentioned. So inputs, outputs, how many Bitcoins is spent. You can calculate fees, see which block it was confirmed in, etc. As a convenience, however, this information is also provided by various websites. And what these websites do is they take the information from the blockchain and they create a nice graphical user interface that makes it easier for you to see exactly what's in a transaction, and also to click and go from transaction to transaction, from address to address, from a transaction to a block, etc. So it's a nice hyperlinked page. These types of websites are called block explorers. You can find one at blockexplorer.com, at insight.bitpay.com, at blockchain.info, and a bunch of others. So you can also search on Google for Bitcoin Block Explorer, and you'll find links to many of these. Alejandro asks, the process to create a Bitcoin address from a public key has been described. It would be nice to know the reasons for each of the steps. For example, why is the SHA-256 algorithm applied, and why are we combining SHA-256 with RIPE-MD160? Great question, Alejandro. Let me explain. The reason that Bitcoin addresses are produced as a fingerprint or hash of a public key is because that gives us a layer of abstraction. And this protects us in two ways. One, it ensures that if there is a problem with the cryptographic mechanism for digital signatures, the public key cryptography, which uses Bitcoin's elliptic curve, having a hashed Bitcoin address means that you don't know what the public key is. So you can't simply go onto the blockchain, find the public key, and let's say you could reverse engineer the private key, spend other people's Bitcoin. So even if the cryptography behind Bitcoin is broken somehow, you still can't spend other people's Bitcoin because you don't know their public key. And so you would need to somehow reverse the fingerprint algorithm, SHA-256, which is conceivably a lot harder to reverse than the public key cryptography, or at least it uses different mechanisms. So that's why, that's one of the reasons why, for security. The other reason is that by using a hash as an abstraction of a public key, you can turn the payee into a field that can use a variety of different types of payees. So the idea was that, okay, for now, what we want to do is be able to pay someone by referring to their public key. But what if in future we wanted to develop other types of payments that did not refer to public keys? And so by having a hash, we can then have a layer of abstraction that allows us to introduce new types of payees. And we saw, in fact, in 2012, a new type was introduced, which is called pay to script hash, which basically means pay a script. You'll recognize pay to script hash addresses as starting with a 3 instead of a 1. And that's to differentiate them from Bitcoin addresses because they are script hashes and not public key hashes. But in every other way, they're just the hash of something. In this case, a Bitcoin script or redeem script, rather than a public key. And this gives us a lot of flexibility. The most common type of script used in that is a multi-sig script. But you can also do a lot of different scripts, combining features such as lock time, which is a time-based lock, and multi-sig and single sig and all kinds of different conditions together. And you can use conditionals like if X and B and Y or Z, then do this, or if A, B, C, then do that, else do this. So you can have a really complicated structured script, and these are most often used as smart contracts. So by putting a hash instead of a public key, we have the flexibility to introduce new types of payees, including scripts. The other question you asked is why combine SHA-256 with RIPE-MD 160? And the reason for that is because if you took a SHA-256 and encoded every address as 256 bits, it creates a rather long address. Even if you encode it in base 58 encoding, it becomes rather long. RIPE-MD 160 produces 160 bits of output instead of 256 bits of output. So essentially, RIPE-MD 160 is used as a compression algorithm. It's used to compress the final fingerprint so that the outcome of it is shorter. And when you produce that as a 58-character encoded address, base 58 encoded address with a checksum as we use in Bitcoin, you get about, I think it's about, I can't remember exactly the number of characters it is. I think it's 36 or 37 characters. If it had been SHA-256, it would have been significantly longer than that. So, so that's why SHA-256 is combined with RIPE-MD 160. This leads to another interesting question, also by Alejandro. As a Bitcoin address is created from a random number, it can happen by mere chance that a wallet creates an address that already exists and contains Bitcoins. Also, the hashing function could create the same hash for two different texts, just because there are less hashes than texts. This can cause Bitcoin address duplication also. How unlikely is that? So this is a great question. When we talk about the Bitcoin address, and in fact, I'll take it one step further. Rather than looking at the Bitcoin address, let's look at the first random thing, which is the private key. The private key is a random number, and you draw that number from a set of numbers that is slightly less than 2 to the 256. It's actually the order n of the elliptic curve, which is a very, very big number. But the bottom line is that you're looking at some 10 to the power of 70 possible combinations. 10 to the power of 70 is 10 with 70 zeros after it. And that is a very, very large number. So you are correct when you say it can happen by mere chance that a wallet creates an address that already exists and contains Bitcoins. The question is, what is the chance of that happening? And the chance of that happening by random is 1 over 10 to the 70. One chance out of 10 with 77 zeros after that. To put it differently, if you were taking a national lottery and drawing a ticket every single day, and you bought 1 million lottery tickets a day, and the combination would be the same as winning 1 million lotteries, it's an inconceivably low probability. So theoretically, it can happen by mere chance that you create a wallet randomly that happens to be the same as somebody else's by picking the same private key, which produces the same public key, which produces the same Bitcoin address. But the chance of that, even if you were creating trillions of private keys per day, it would take trillions of years before you actually did that by chance. So the other thing you talked about is the hashing function could create the same hash for 2 different texts, just because there are less hashes than texts. This is called the collision, a hash collision. And hash functions, of course, do have collisions. It is possible to create, for example, 2 different scripts that have the same script hash address. 2 different blocks that have the same hash, 2 different transactions that have the same ID. It is theoretically possible. And again, the chance of that is a collision on a space of 2 to the 160, which is less than that of the space of private keys. It's a smaller space, but still vast space that you could merely come upon it by chance. More importantly, however, a collision in the hashing function is not just a matter of finding some combination of data that would produce the same hash. You have to find some combination of data that would produce the same hash in a meaningful and useful way. So perhaps some combination of Bitcoin script commands could produce the same hash. Whether that would actually allow you to spend the money behind that pay to script hash address or Bitcoin address is a whole other question. And so even though the space is smaller, the actual usefulness of a collision in that space is much less than the possibility of a collision in the private key. Again, the whole point of this is that the probability is so vanishingly small that even if you were trying trillions and trillions of addresses per second, you would be unlikely to find a collision in trillions and trillions of years. All right, let's see. All right, I've got one more question from Alejandro, which is very interesting. And Alejandro says, I imagine a transaction as a string of characters. However, that string contains several parts with different purposes. How is the subset of a transaction chosen to create the signature, and how is it informed into the transaction? Which part of the total transaction is signature, and which part is not signature? Which part is the part that is being signed? That's a great question. So let's clarify exactly how this works. So a transaction as a string of characters. Yes, essentially a transaction is a string of, well, bytes, but it's a data structure. And within that data structure, there's structure, meaning that specific bytes in a specific order mean specific things. And you can parse that structure. You can decode that structure. So you'll start off with the beginning of the transaction containing certain information. So I believe, if I'm not mistaken, the first part of the transaction is a sequence number. Right after that is a path that tells you, a part that tells you how many inputs the transaction has and how long that part of the inputs of the transaction, how many inputs it has and how long that data structure is. Then there's a part that tells you how many outputs the transaction has. And then the main part of the transaction starts. Now, because you know how long an input is, you can then start looking at the inputs and then parsing those. And each of these structures have additional information that allow you to predict how long it's going to be and how much of it belongs to this input versus the next input, and so on and so forth. So you can break down the structure of the transaction. So yes, transaction is a data structure. It has specified lengths and paths and parts and can be parsed. How is the subset of a transaction chosen to create a signature? And how is it informed into the transaction? Which part is part of the signature and which is not? There is a specific part of an input. So in the input, there is a specific field, which is the script sig. This is also known as the witness, which is something we'll talk about later in this course when we talk about segregated witness, which is taking this information out of a transaction. But the witness is the signature part of the transaction, or also known in the code as script sig. Every input has script sig. So every input is signed independently. Only the inputs have script sig. The script sig is the signature for each of the inputs. As part of the script sig, there is a field within the script sig that tells you which part of the transaction the signature is signing. That is called the signature hash type. And I'm going to drop a link. You can actually find this information in the developer guide on bitcoin.org. If you search for signature hash types. And I'll drop a link into the Hangout now so that everyone can see it. Let's see if I did that correctly. Whoop. There we go. So there you go. That's the signature hash type. So at the moment, there are 3 signature hash types defined and a signature hash type flag that modifies these 3. The signature hash types are sig hash all, which is the most commonly used signature hash type. And this says this signature signs all the inputs and all the outputs, protecting everything except the signature scripts themselves against modification. So that's sig hash all. Most transactions you see, most transactions your wallet creates are sig hash all, which means that everything except for the script sig itself, you can't sign a signature with itself. That's not possible. So therefore, the signature itself is the only part of the transaction that is not signed, which, if you're interested, is also part of the reason why transaction malleability occurs. But without going on that tangent, sig hash all means signing all inputs and all outputs. Sig hash none signs all of the inputs, none of the outputs. That means that the outputs can be changed, meaning that essentially you're donating this money to whoever wants to redeem it. There's some reasons why you would use that in particular combinations, which we'll look at in a second. The sig hash single signs only one output, and it's the output that corresponds to the single input that you already have. So for example, if you put sig hash single in the first input, then it signs the first input and the first output. If you put sig hash single in the third input, then that signature applies to the third input and the third output. So you have to have, if you're using sig hash single, you have to have a corresponding output of the same index number in the transaction, which you are signing. There's also a flag called sig hash anyone can pay. And this is used as a modifier, creating 3 additional types. Sig hash all, sig hash anyone can pay. Sig hash none, sig hash anyone can pay. And sig hash single, sig hash anyone can pay. What sig hash anyone can pay means, really, is that anyone else can add or remove inputs, and or add or remove outputs. So the first one is sig hash all, sig hash anyone can pay. That signs all the outputs, only one input, and allows anyone to add or remove inputs so that they can contribute additional funds to this transaction, but they can't change where the funds are going. Now, one interesting application of this type, sig hash all, sig hash anyone can pay, is to create a special kind of transaction, which is a Kickstarter transaction. This was used by the Lighthouse client, which is one implementation of this trick. So here what you do is you say, for example, we're going to do a fundraiser, and I'm going to raise 50 Bitcoin for a civil liberties charity. Great. So we create a transaction that has perhaps no outputs and no inputs, and one output for 50 Bitcoin going to the charity. And then each donor adds an input that they sign with SIG hash all, SIG hash anyone can pay, that signs the outputs that send the money to the charity and signs their inputs. Let's say they give 1 Bitcoin. Now, this transaction is not valid. It's not valid because you have 1 input Bitcoin and 50 Bitcoin output, so there's not enough money to fund this transaction. But other people can now add inputs. So someone else comes along and adds another 10 Bitcoin. Now you have 11 input, 50 output. It's still not valid. And you keep on doing that. Since the outputs is fixed, you can't spend this transaction until you have enough inputs to spend to pay the outputs. So the transaction is not valid until you've raised enough money. And so that's how a Kickstarter type funding is used. With SIG hash anyone can pay and SIG hash all, SIG hash none, SIG hash single, you can create a variety of interesting schemes. And it can be used in other tricks that we'll see later, including in the case of segregated witness to create upgradable scripts through script versioning and a soft fork. So we'll talk about that sometime later in this course. Let's see if we answered Alejandro's question. Do we have any follow-up on that question? I'm just going to pull up the Q&A, make sure I can see everything. Ah, yes, we've got some questions coming in. All right. Don asks, how can we trust the random number generator of a hardware wallet like the Trezor or Ledger? How do we know it is truly a random private key that is generated and not something that is from a seed that someone back at headquarters has? This is a really good question. The truth is that there's no way to check a random number generator to check whether it is truly random, because truly random doesn't really mean anything. You can do statistical tests to see if it looks random, but that doesn't give you any guarantee that what it looks random means that it's not deterministic random based on a seed that someone can predict. Hardware wallets like Trezor and Ledger use hardware wallet generators. Sorry, they use hardware entropy generators that are built into these wallets. Usually that's a system that amplifies noise in a cascade, and that causes a signal that is random. But verifying that that is correct or not is something that requires an understanding of how the hardware works, as well as the software implementation that that derives keys from that entropy. So the only answer really is you either trust the developers of this device, which is something you have to trust in general. You know, how do you know that the wallet you're running on your computer is truly random, or that the computer itself is producing random numbers, or that your phone is producing random numbers? And we've seen on several occasions random number generators both fail as well as be compromised by security agencies, or I should say insecurity agencies that are compromising security systems. And so we don't know whether random number generators are truly random. You can go to quite extremes trying to produce truly random numbers. And you can create your own seeds. One of the things you can do if you're absolutely paranoid is you can input your own seed into a Trezor or Ledger by creating your own seed, converting it into a 12 to 24 word mnemonic, and then entering that mnemonic into the Trezor. So then you need to build your own random number generator. For the truly paranoid, that is an option. You can use a variety of mechanisms to do that. from the very technically sophisticated, such as, for example, using a Geiger counter to measure cosmic radiation. And you can also use very simple mechanisms. For example, you can go on Amazon.com and you can buy casino dice, which are dice that are very carefully calibrated and built so that they are truly random. They have, they're properly weighted and balanced, transparent acrylic dice. You can buy dice. And then you can roll your own 128 or 256-bit key by rolling dice and writing down the numbers that come out, converting those into a binary number or hexadecimal, as the case may be, using that to produce some mnemonic word or a set of mnemonic words, and then feeding that into a ledger in Trezor. So that's not a very good answer, because most people will not want to do all of that. The bottom line is it's a matter of trusting developers and also relative security. It's more likely that a Trezor and Ledger are more secure in terms of their hardware random generators than your laptop or your phone, because they've been designed to produce strong hardware randomness. It's more likely that you can trust those developers versus the developers of any other random hardware that you may have bought. But it's a good thing to be a bit suspicious of claims of randomness, because there is no way to validate it. Don asks, what are your thoughts on the demise of Bitcoin Armory? I'm asking that both from a user point of view. So I now need to get my cold storage, paper, M of N backups that I hid all around the country together to restore the wallet and transfer out. And from a business point of view, how can wallet developers actually make money once the initial hype is over? Bitcoin Armory didn't really run out of money. That wasn't the primary problem. I think the primary problem was far more common, which is internal disagreements and problems within the partnership. And you know, there've been a lot of things written about that in public, and that's all I can say. But the bottom line is that it is difficult to create profitable solutions in this space, especially when this space is in its infancy. That's not a problem with open source or Bitcoin specifically. It's the problem with any open source technology or any disruptive technology. Sometimes being too early is just as bad as being too late, or even worse, and you can't get the appropriate funding. I would certainly recommend looking at alternative solutions, and I think you will find that there are now many very good multi-signature solutions that can address your needs in a way that allows you to migrate away from a platform that is no longer maintained. Although I am hearing that some of the developers are working on continuing the maintenance of Armory. So you may see that project revive itself over the next few months. All right, let's see what other questions we have from the forums. Ava asks, if at some point it is decided to increase the maximum number of Bitcoins, wouldn't it be a very similar system like the fiat currencies we have today? Well, yes, that would very much be the case. I'll answer in the same way that some of my ancestors answered. When the king of Macedonia told the Spartans, if I invade your country with my troops, I will destroy your kingdom, the Spartans replied, if, because that's a truly interesting hypothetical, but they didn't think he was going to do it. And in fact, Sparta remained independent of the kingdom of Macedonia after that answer. So if at some point it is decided to increase the maximum number of Bitcoins, that is a very big hypothetical. Decided by whom? And this is the real question, because no one is in control of Bitcoin, and therefore this decision would have to be unanimous by all the participants within the Bitcoin system. You would have to engage every constituency of interest in Bitcoin, including miners, obviously, software developers, the exchanges, merchants, user wallets, and the users themselves, everyone running a node. This would be, at the moment, we're having an enormous amount of controversy and difficulty changing a much less substantial parameter of Bitcoin, which is simply deciding whether an increase in the block size limit will lead to more or less centralization, or when exactly it should be increased. And that decision has been in deadlock now for almost a year. I can guarantee you that if anyone suggested increasing the maximum number of Bitcoins, they would find that nobody wanted to follow that plan. Because an increase in the number of Bitcoins directly affects everyone who holds Bitcoin today by reducing the value of their Bitcoin, then it is unlikely any of the people who already have a stake in Bitcoin would agree to a change like that. And since you require unanimity, that's probably the one parameter that is never going to change. Which means effectively that if you tried to change that, you would be creating something that is not Bitcoin, and that would be a different currency, and Bitcoin would continue with the old parameters. You'd eventually just fork off a minority. So the answer is, would it be a very similar system like the fiat currencies? It's not a similar system precisely because no one can impose that kind of change on the system. In traditional fiat currencies, the central bank can make that decision unilaterally, very often without any recourse to elected officials or the parliamentary system or any kind of democratic decision-making process or any debate in public. And the end result is that's why Bitcoin was created in a way that requires broader consensus. So the maximum number of Bitcoins will not increase. Also, you've got to realize it's not simply a matter of changing a single parameter in the code and saying, let there be more. You would have to tweak a number of different parameters, because the reason you get less than 21 million Bitcoin is because the rate of production of Bitcoin is fixed, and it's fixed in a geometrically decreasing pattern where it's divided by 2 every 4 years based on a fixed initial issuance rate. You'd have to tweak either the amount of reward in a block, or you'd have to tweak the algorithm that decides how to evaluate the reward, or you'd have to change the block timing, all of which would be fiercely resisted. Panayotis asks, can you comment on current scalability issues? Is Bitcoin meant to be a great transactional mechanism for everyone and everything in the world, or is it merely a settlement mechanism, digital gold? I don't know. And I don't think anyone really knows whether Bitcoin is meant to be one or the other, or even that the two are mutually exclusive. I think we're still exploring this idea, and the debates we're having at the moment is not really fundamentally about that, although it appears to be fundamentally about that. And I think that in the end, there may be philosophical debate about what Bitcoin is and what Bitcoin should be. But Bitcoin finds its own niche, and it will continue to evolve within the environment that it exists to find its own niche, and people will use it for different purposes, and that's what's going to determine what it is for. I don't think that we are even able to change some of the parameters dramatically, and I think it will continue to be a transactional mechanism and a store of value, and a settlement layer, but also a payment mechanism. We're going to see how it evolves. I think a lot of the functionality of Bitcoin will have to move to layers of the protocol higher up than Bitcoin. For example, using the Lightning Network. I also think that we're going to increase capacity, raise the block size limit, and increase capacity on the main chain at the same time. And we're also going to optimize the scaling of various aspects of Bitcoin with things like segregated witness, thin blocks, and various other tweaks to Bitcoin. This is going to be an evolving story. And I don't think we answer the question you asked for decades. There's a similar question here, which I'm going to address. It's a bit of a tangent, but I'll go into it really, really briefly. I've heard an argument in the block size debate that small blocks will benefit Blockstream because they are developing the Lightning Network. I've tried to read up on the Lightning Network, and I can't understand how Blockstream is supposed to make any money from the Lightning Network. Well, first of all, Blockstream is one of the teams developing Lightning Network compatible implementation, but they're not the only one doing it. They're not the ones who invented it. And actually, I don't think Blockstream benefits from the Lightning Network any more than it benefits from not having the Lightning Network. I think the Lightning Network is something that benefits everyone in Bitcoin. And we're going to have something like the Lightning Network anyway, whether we resolve the block size limit issue soon or not. So a lot of this is wild conspiracy theory and an echo chamber of people who don't understand this problem or the scaling solutions being proposed, just basically casting accusations all about. There's no nefarious conspiracy here. And I think the whole debate has been completely overblown. I'm not going to take a position for or against any of these technologies, because I think in the end, we're going to get all of them. Probably before the end of 2016, we're going to see a block size limit increase, the implementation of segregated witness, and the first implementations of Lightning Network, as well as several other scaling and optimization solutions. Let's see what else we have from the forums. All right, that's everything from the forums. Let's go back to the Q&A, the live Q&A. Okay. Lalita asks, please let me introduce myself as a tech illiterate banker. It would be very beneficial for my learning if you could fill up my gaps below. Wallet equals bank account. Private key equals transactional signature. Public key equals question mark. Blockchain equals accounting ledger. QR code equals account number. Exchange equals intermediary or bank. Thank you and regards. All right. Well, Lolita, it's not that simple. And the reason it's not that simple is because it would not be beneficial for your learning or for the explanation to make comparisons between Bitcoin terminology and existing banking systems. And the reason is that they are sufficiently different that when we use words that sound the same, those create expectations about how these things will behave. A wallet is not a bank account. And neither is a Bitcoin address a bank account. You cannot create a near infinite number of bank accounts without asking the bank on your own, using pencil and paper. You can't do that. You can do it with Bitcoin. You can create an infinite number of Bitcoin keys. And you don't even need a computer to do it, let alone a connection to the internet, anyone's permission or registration with a network. You're essentially creating your own numbers that become account numbers, but they're not really account numbers because they're really just collections of private keys that control entries on the ledger. Private key is not a signature. A private key can produce a signature. A public key is somewhat similar to the payee on a check, but not really, because we use a level of abstraction above that. And you can't really tell who the payee is. It's more like a numbered account number, but again, you can create an infinite number of them without asking the bank, and nobody controls it, so it's not a very apt description. The QR code and address are really just expressions of a payee, but again, they're not equivalent to an account number. They're not even equivalent to a public key most of the time, or some of the time. They may be corresponding to a script or some other form of payee. An exchange or wallet or blockchain info is not really a bank, and in some cases may not be an intermediary. Blockchain info is not an intermediary at all. They have no custodial control over the Bitcoin that users use on blockchain info. The wallets there are stored entirely by the users themselves and controlled by the users. So it's not a very good analogy. A lot of the exchanges don't operate anywhere near the same way that a traditional exchange would operate, or a bank or an intermediary. Some of them have custodial control over funds, and they look much more like banks. Many of them don't, and have a completely different structure. Or rather, many of them look like banks. Some of them don't, and some of them behave very differently. So in short, understanding Bitcoin by making analogies to the existing banking system is really misleading. What it does is it robs you of understanding, because these concepts are very different and because they behave very differently. In fact, a lot of the words that we use in Bitcoin are poorly chosen as design metaphors, because instead of informing you as to the expectations of behavior of this thing, they misinform you. They lead you to draw conclusions that are not accurate. A wallet is not a wallet. It's actually a keychain. And the word wallet isn't very good because you can't copy your wallet, but you can copy your keychain. A wallet contains currency. Bitcoin wallet doesn't contain currency. It contains keys which control currency on the ledger. A Bitcoin address doesn't correspond to an account, and it also doesn't correspond potentially to a person. Machines can have addresses without any human interaction, so you can have computers that own money without people. You can't do that with bank accounts. So a lot of these metaphors are really, really broken. I would suggest trying to experience the technology behind Bitcoin and trying to dig deeper. And you will be surprised by some of the behaviors that appear in Bitcoin because it's so radically different from traditional banking. And perhaps that will give you a better insight into why Bitcoin is really interesting and different, because it's so different from traditional banking. Lorianne says, can you give an overview of Merkel root, Merkel tree? Possibly. So what a Merkel root, what a Merkel tree is a hashed binary tree, or binary hash tree. And what that means is it's a tree. It's a binary tree, meaning that every parent has 2 children, not more, not less, exactly 2. So every level has twice as many members as the level above it. You start at the top with 1 node, and that's the root, and it has 2 children, and each of those children has 2 children, and you go all the way down, and it has no limit to its depth. You can take any number of entries. Let's say you take 2,000 entries. Okay, so you put 2,000 entries at the bottom of the tree, and you can express 2,000 entries with 11 levels of tree, or 2 to the 11, because each level multiplies the number of entries by 2. So if you have 2,000 entries at the bottom, you have 11 levels of tree above it. So what it allows you to do is summarize very large data sets. And the larger the data set, the more efficient it is to summarize it in a Merkel tree. Each level, each node on the tree is a fingerprint. At the bottom of the tree, it's a fingerprint of specific data. In the case of Bitcoin, we use Merkel trees within a block to summarize all of the transactions. The bottom level of the Merkel tree in the block is the transaction hashes. It's the hash of a transaction. Each leaf at the bottom of the tree is one transaction hash. It doesn't matter which order they're in. They are ordered in whichever order they're ordered in the block. But the bottom line is that the first and second transaction hashes that are in the tree, which are, if you draw the tree on the, let's say, bottom left side, are then hashed together. So you have two transaction hashes, let's call them A and B. Those are the transaction hashes of the first and second transaction in the block. If you hash them together, you create a new hash, the hash of A plus B. And that goes in the node immediately above them. So hash of AB is the node above them. And then transactions C and D are hashed together, and they become hash of C and D, E and F, G and H, I and J, all the way to the end. And you can hash all 2,048 transactions into now, let's say you have 1,000 hashes, which summarize two transactions each. Now, if you pair those together and then hash them together, you summarize them down to 512 hashes. Then you hash those together, summarize them down to 256, 128, 64, 32, 16, 8, 4, 2, 1. And so the top hash basically contains within it the hashes of all of the levels of the tree, all the way down to the bottom. You can also use a Merkel tree to prove that a certain member is in the tree by providing a very short description or path that proves that, let's say, transaction J, which was at the bottom of the tree, is part of this. And the way you do that is by providing the other side of the pair of each hash all the way up to the top of the tree until you get to the root. So if you have the root and you have the opposite sides of the 11 pairs of hashes in that 11 level tree, with just 11 numbers, 11 hashes, you can prove that one of 2,000 transactions is part of that tree. And so what it does is it gives you not only a way to summarize vast amounts of data, but to also cryptographically prove membership in a set with a very short descriptor or path that is only as long as the number of levels in the tree. So that's the power 2 logarithm of the number of elements in the tree, which is a very efficient algorithm for summarizing data. So that's what a Merkel root is. It's a way of summarizing data using hashes with pairwise hashing up to a single member in a tree. We only store the roots, the top member, and then we can very easily prove that any of the individual elements within that tree are present in that tree. So you can prove that a transaction is part of a block by providing the transaction hash, 11 pairwise hashes, and the Merkel root, and that's proof to anyone that they can validate themselves that that hash was included in that tree. Let's see if that, I hope that answered that question. Let's see what other questions we have in the list. What, in your opinion, will happen with the Bitcoin price when halving? Well, the price is likely to start fluctuating before the halving, as people anticipate the price will likely go up or maybe go down. And because they anticipate that it might go up or down, they will either buy or sell, which will make the price go up or down, which will then cause other people to say, aha, I knew it, it's going up or down. and then also buy or sell, and amplify that response, causing the price to go further up or down, which causes more people to buy or sell until everybody says, no, no, this isn't right. Let's reverse our position. I don't like this anymore. I'm going to start buying or selling. So the price will go in the opposite direction, up or down, and up or down, and up and down, and up and down. And we're going to see a lot of volatility. So the best prediction I can give you is that in anticipation of the halving, people will get excited about movements. Their excitement about movements will create more movement, which will create more movement until the movement becomes unsustainable, at which point it will reverse itself, causing more movement in the opposite direction, which will cause another panic or another exuberant party. And people will continue buying and selling and buying and selling, and you get a lot of volatility. Eventually, the price will settle, probably after the halving, probably several days, weeks, months after the halving. And it will settle at a price which will have an effect on both the hashing power, difficulty, and profitability of miners. And I don't think there's anyone who can give you a prediction as to what will happen to the price, other than things will get very volatile before, during, and after. You can try to predict and play that casino game if you like. I will avoid trading during that time, and I will continue my existing policy, which is every now and then buy or sell Bitcoin as I need it to pay my bills or earn my living, regardless of what the price is doing, and without paying attention to the price, and on a specific day each week, regardless of what the price is doing. That's called dollar cost averaging. And over the very long term, it is the only way you can shield yourself from volatility. All right, let's see. Graham asks, it looks like the banks are trying to hijack the blockchain conversation via permissioned ledgers. Do you see any threat to Bitcoin's future path, or are these developments parallel or even helping to move the whole digital territory forward? Yes, Graham, you are correct. The banks are trying to find a way to reconcile this very disruptive technology with their need to maintain control, maintain power, and maintain profitability. And so they're trying to find ways to dampen the disruptive potential by removing all of the interesting things in Bitcoin: the open access, the innovation, the borderless nature, the censorship resistance, the pseudonymity or anonymity that comes with it, the ability to use it in a decentralized manner. We're going to talk more about permissioned ledgers in the next section. The bottom line is I see no threat to Bitcoin's future path. Bitcoin is not really concerned with what the banks do. What it does, however, is it means that a lot of money is being invested in developers who are learning about blockchain technologies. And these developers can also use those skills to develop the most interesting, the only global decentralized and open access largest blockchain we have, which is Bitcoin, and some of the other blockchains that are getting large, that are open and decentralized and interesting, perhaps Ethereum and others. I am not worried about this. I think it helps the entire digital territory move forward. In fact, it is acceptance and demonstration that the concept of blockchains is correct. However, they have failed to see that the most important thing in the concept of blockchains is an open consensus proof of work algorithm that keeps the system open and decentralized. All right, next question from Alex. Given the volatility in the price of Bitcoin in the past weeks, is it possible that this is some sort of currency manipulation scheme? The price tops 450, then drops all the way to 390, then goes back up and back down. Someone's making a lot of money in this trade. If you think that the past few weeks have been a time of volatility, you haven't been around long enough. Bitcoin has experienced far, far more volatile periods than this. In fact, we are now living in the golden age of low volatility as far as Bitcoin is concerned. These movements of 10% are tiny. Check June 2011 for comparison, or even November 2013. We've had volatility on the upwards cycle. We've had volatility on the downwards cycle. And we will continue to have volatility. Is this market manipulation? Sure it is. There's a lot of people who are playing the market, and there's a lot of people with deep pockets and much better experience at being day traders who are probably making a lot of money off panicky noobs who are buying high and selling low. And so that's why you shouldn't treat Bitcoin as a day trading job unless you know what you're doing. I stay away from that. I'm glad that other people do it because it provides liquidity for the economy. And all of this speculation actually, in the long run, increases the volume of transactions and the volume of currency, which is good for the economic health of the system. But I'm not going to put my own money into playing that game. Next question. I know the answer is looking into Bitcoin's code, but since I haven't checked it yet, could you briefly explain how are Bitcoins released into the Bitcoin system? Who owns these Bitcoins? It's a question from Ava. You know, ironically, Ava, if you look into the Bitcoin code, you won't find the answer to your question. It's not as obvious as might appear. Certainly not in the code. If you read the code, you won't see anywhere where it says, and now give Bitcoin to this person. Or you won't find any instruction like that because that's not how it works. So to explain how Bitcoins are released into the system, you have to understand mining. And the process of mining is a competition. All of the miners who are engaged in this competition create candidate blocks, hoping that they will win the competition. Within these blocks, they put one transaction as the first transaction, and they make that transaction like a blank check payable to themselves. It's a check drawn on no account whatsoever because it's drawn on new Bitcoin that will be created if this block comes into being. So every miner writes a block. In the block, they put a transaction that pays them 25 new Bitcoin. This is the reward. It's currently 25. It's going to go down to 12.5 in July. And that transaction, which they've written to themselves, is not valid unless that block is permanently part of the blockchain. In fact, 100 blocks have to elapse before that first check can be spent, the so-called coin-based transaction. So the way the Bitcoin comes into being is simply by the fact that out of all of those thousands of blocks that people create with the hope of winning this competition, only one in the end becomes part of the permanent record. And whoever found the solution to the block algorithm first, it means that their block becomes accepted as valid, is distributed across the network, is accepted by everyone as valid, is embedded and recorded into the blockchain, and then other people start constructing blocks on top of it as descendants of it in this chained link, the blockchain, and so in this linked chain of blocks. And so by creating other blocks on top of it, they're recognizing the fact that it is part of their blockchain, which means that it is recognized as part of the overall blockchain. The more blocks that go by, the more solid that consensus becomes. And after 100 blocks has elapsed, then that transaction becomes spendable. Once it becomes spendable, that means that that miner can now use that to pay their electricity, send it to an exchange and receive currency, or buy something from someone who accepts Bitcoin and pay salaries in their company, pay themselves a nice little bonus, whatever it may be. By spending this coin-based transaction, they introduce and inject this money into the economy. So nobody decides and nobody owns these Bitcoins until a block is decided as the winner, and not until after 100 other blocks have been laid on top of it. You won't see this anywhere explicitly in the code because it's a process that occurs all across the network simultaneously, on each node, from its own perspective, it decides what is the current longest blockchain. And through this process of decentralized consensus, over time, one single definitive authoritative blockchain emerges as the one true chain, the one winner. That process of consensus creates this artifact. The blockchain is an artifact of consensus. It is the product of everyone agreeing about the recent history of what happened in Bitcoin. And in that process, the reward that a miner gave themselves becomes accepted by all as a real reward because that block won. And as a result, it can be spent and people will accept that money in payment. And so it becomes part of the permanent history. And that's how money is injected into Bitcoin. All right, let's see if we have any other questions. It seems like we've run out of questions. Once again, perfect timing, just about 1 hour. I'm going to do a quick check, make sure we don't have any more questions. All right, do we have any more questions that I have missed? All right, fantastic. Thank you all for attending this session. It worked very well. Our next live session is March 16th, same time, and I'll take that question for next time, Cisco. Thank you so much for listening. This has been the massively open online course for digital currencies for the master's degree at the University of Nicosia, and I've been your host, Andreas Antonopoulos. Please don't forget, ask questions in the forums to give me plenty of material. Come join us at our next live hangout on March 16th and ask live questions, and I'll see you then. Good studies.